Yes, we are back. Welcome back to the program, guys. So we took a week off from the live stream just because I was out of town. I was in South Carolina and I didn't take all of my cameras and stuff with me. I say all of my cameras. I didn't take my camera, my light, and stuff like that with me. So, just didn't make sense to try and do a live stream from there. And then when I got back, we had company from out of town. And so now everyone's gone and the house is empty. And I am here with you, my friends. So let's go ahead and get started. Um, we've got just a few on the program at this point, but I do want to share with you something that is really interesting, I think. And, it's really up to you guys, but there is an opportunity, I guess, and I'm going to play around with this, but I wanted to share this opportunity with you guys as well. There is a bit of a time limit on it, so let me just share this with you. Whoops, I'm going to add that to the stage. So there is a investing group. I'm going to go ahead and take this off. Maybe. There we go. And then I'm going to take me off of there as well. But this is something called Alpha Picks. So if you're part of Seeking Alpha, you may have seen this in the info here on the left-hand side of the screen. But it's basically an investing group, and it's made up of people that are of Seeking Alpha, and they call it Alpha Picks. So Alpha Picks has a portfolio out there, and they send information out, as they do picks, or they, like this one has been removed from the portfolio. They basically have a portfolio of stocks out there that they are seeking to gain alpha, which is that above market return. And one of the things that's fascinating to me, guys, is that they have a 105.6% return versus the S&P of 32.84. And they say here that AlphaPix performance is calculated starting from July 1st of 22, and it's based on every whatever. You can read all of that, but at the end of the day, so that's what a year and a half maybe of data. Maybe that's when they got started. But I find that to be fascinating, and I'm going to play around with that. But we do have the opportunity to save 55% on subscribing to that. I think it's $89 for the first year, and but that only lasts until the 15th of February. So today happens to be the 12th. So you got 3 days to kind of think and mull that over. If it's something you're interested in, just follow the link in the notes to this live stream, and you can get that 55% discount. So just thought I would pass that on to you. I don't have a lot of experience with it, so I can't tell you that, hey, I have gotten these returns, because I have been in it for a couple of weeks now, but not anything long term. So I'm still checking it out, but for this kind of a deal, for this kind of a savings, it's kind of hard to pass that up, at least the way I look at it. So just wanted to pass that along to you guys. And then with that, I think we'll go ahead and get started. Before we get started, I want to see who is in the live stream today. So let me get back over here and hit the comments. So it looks like our buddy Gnome is going to be skipping today. So that's fine, my friend. We will. You can see me tomorrow, man. I will be on here. It'll be, of course, it'll be delayed broadcast for you, but that's okay, my friends. Good to have you in the broadcast for a short period, anyway. And to Tommy is here. It's good to see you. And then Chris, my buddy, my Penelec buddy, my Pinnacle West buddy. So hey, I appreciate you being on the broadcast today. And afternoon all, bought time. I don't have to work on a Monday. That's all about time. Doesn't have to work on a Monday. That's fantastic, man. I'm glad you are here. And Greg has no school for the kids. I bet that is quite a relief. So, or maybe your kids are home and maybe it's not. But anyway, either way, man, that's great. So it's good to have you guys here. I think I'll go ahead and get started with the subject at hand. And somebody asked for this. Let me figure out how to do this. I can't walk and chew gum most of the time, so so there we go. So somebody asked for a bit of a talk around share dilution, and so the more I dug into that, the bigger it got. Right? It's a pretty big subject, but I thought it would be helpful and interesting actually to go through this with everybody. So I'm gonna do this right here, hide that, and then probably gonna yeah, I think this is good right here. There, that's much better. So we're going to talk about share dilution, and the two questions we're going to ask are, what is it, and why do I care? All right, so let's get started. What is share dilution? Share dilution occurs when a company issues new shares that result in a decrease in the existing stockholders' ownership percentage of that company. And you may ask, how does that happen, right? Well, I thought a really simple example might be good. And so here's our first example. Our first example is a company has $8 in earnings. And this is a fictitious company, obviously. It's a very simple example. And they have four shareholders. So in this scenario, $8 in earnings, they have four shareholders. They split that among each shareholder so that they have $2 in earnings per share. I say four shareholders. They have four shares, not four shareholders. It could be one shareholder, but they have four shares. They divide that $8 in earnings divided by the shares, and so that gives each share a $2 earnings per share. Okay, does that make sense? So $8 divided by four shares is $2 per share. So now let's say that the company decides to issue more shares. And why would they do that? We're going to talk about that in just a minute. But if they doubled their shares in our example, and instead of having four shares, they now have eight shares. So they have eight shares, still have earnings of $8. So $8 divided by eight shares now is $1 per share. So what's happened there is these shares have been what they call diluted, so that the existing shareholders now own less of the equity of the company because there are now new shareholders, more shareholders, or more shares that have been issued. So that's the uh, issue at hand. Is what is it? It is basically when a company issues more shares, basically. So why does it occur? And I think this is really interesting and is good for dividend growth investors to understand this, because we really want to understand what our management teams are doing and what levers they have at their disposal. So the first thing is dilution can raise additional equity capital for the company. So let's say that the company decides that it wants to expand. So, they may want to grow the business. They may want to build a new manufacturing plant or a new chip, plant somewhere. One way to do that is to issue equity. And when they issue equity, that equity goes onto the market. It is basically an IPO within the stock, and those shares gather cash from the initial purchasers, and that cash comes to the company as cash. And so the cash then can be used to build facilities or build a chip manufacturing machine or whatever they need it for. And basically those shares now are new shares, and the company ownership has been divided into more parts. All right, so they may want to expand the business. That may be one reason they do it. They may want to acquire a company, and I put in accretive business here. It doesn't necessarily have to be accretive. Accretive means that they start making money on day one, but sometimes things don't go the way they think. So, but if they're going to acquire a company, they might issue additional shares to do that. or there may be some combination of shares and debt, but you get the point. They may issue some shares as part of an acquisition. The third thing is they may decide they want to improve their balance sheet and reduce debt. And one way to do that is to issue additional shares. And so that goes to improve the balance sheet, but it also helps credit ratings. So if they're needing to improve their credit rating, maybe they're going to go into some debt cycle, or maybe their debt is going to go below investment grade, might be a great time to issue some shares so that they can then reduce their debt and get into a better credit profile. So that's some of the reasons that a company would issue additional equity. The second question is, or not the second question, but the second area of dilution can be through employee stock compensation. And there's a lot of conversation around this on some YouTube channels. So I thought I would hit this briefly. First of all, why would they do that? Why do companies offer stock to their employees as part of their compensation package? Well, the first reason, and probably the biggest reason, is that it aligns the goals of the shareholders and the employees. So if the employee it can be an owner, an equity owner in the business, then they can also make decisions that improve the position for equity owners because they are equity owners now. And so that aligns what the employees' goals are with what the shareholders' goals are. And then secondly, it's good to attract skilled employees. So if you're in a high tech business and you need a certain skill set that's just not readily available in the market, sometimes you got to buy it, and you buy it using equity. So that's another thing. There are probably other items, but these are the main things on the top of my mind. Then the third thing is there are other financing options that a company has that result in dilution. One example of that would be convertible preferred shares. So a company may issue, instead of common shares, they may issue preferred shares, which are really more of a debt instrument, but they could be convertible into common shares. And so that would, if they decide to convert those preferred shares at some point, that could dilute the earnings for the shareholders. So the next thing is, why do I care? Is this something that I really need to care about? And first of all, we should care because dilution eats into the equity interest of each of us as shareholders. So each share of the company would be, we would own less of the company for each share. Each investor owns a smaller portion of the pie, so that kind of makes sense. Dilution can increase the overall cash allocated to dividends. So what does that mean? Let me see if I got anything down here. Yeah, so even if the dividend does not get increased, there are more shares getting dividends. So let's take stock options that a CEO might get, for instance. Those stock options will at some point the CEO would have the option to exercise those options, and when that happens, those shares will be part of the company's shares. And so where the company, let's say the company had 8 shares, and the CEO had an option for 2 more shares, and he exercised that option. Now there's 10 shares. So instead of paying a dividend on 8 shares, now the company's paying a dividend on 10 shares. Hopefully that makes sense, because what that means is the overall cash going toward dividends has gone up, even if the dividend is not increased. So that's one reason why we care. And so now I'm going to give you a couple of examples of how you can find this on the financial statements. I thought that might be interesting for you guys. So examples of dilution. This is Microsoft. And Microsoft, you can see here, this is the bottom part of their income statement. If I tried to get too much of their income statement on here, you couldn't read it. You may not be able to read this. So let me see if I can make that bigger. Here, we'll do that. Hopefully you can read that. So you can see here that Microsoft and for the 3 months ended December 31st of 23, they had about $22 billion in net income. They had 7.4 billion shares and about 7.5 billion diluted shares. So what the way to read this is the existing weighted average shares outstanding at the point that they issued this report was 7,432,000,000 shares. The diluted shares are how many shares they would have outstanding if all of the potential dilution happens. So stock options, preferred shares, et cetera, et cetera. So if all of that happens, then they would have 7,468,000,000. So what is that? About 36 million shares in dilution. So this is Microsoft, and to be honest with you, that's not a lot of shares for Microsoft. So I'm not obviously concerned about that. So you can see then what the dilution impact is by looking at the earnings per share basic, which is that $2.94, and the earnings per share diluted, which would be if all of the shares were to be uh, exercised or issued, or however that's going to happen, then it would, instead of being 294, it'd be 293 per share. So they're giving you that information on the income statement. Um, One other point that I'll make in just a second. I'm going to push that back for a second. So let's do this. I'm going to have to, since I made this bigger, I've got to do this. So hopefully you can see this. This is the cash flow statement. So if you want to know what is the stock-based compensation, so the dilution that happens because of stock issued to employees, that is actually on the cash flow statement. So why is it on the cash flow statement? Well, most people use the indirect method of building their cash flow statement. And so you say, what is that? And so I will just say that they actually start with net income and figure out all of the non-cash events that occur in net income to get down to a change in cash. So if we look at this, there, remember over here it was 21,870 for net income. That's where they're starting here. They add back things like depreciation, amortization. That kind of makes sense. That's a non-cash item. The next item on their list is stock-based compensation. So what happens is a company is required to expense the cost of stock-based compensation, even though it is a non-cash item. So somebody, if they issued the CEO shares, those shares have a value, and the company calculates that value. They put it as an expense on the income statement, but they didn't pay that out. Those are the shares that were issued to the CEO. No cash actually transpired or occurred. So when they come to the cash flow statement, they add it back in. So this is worth the price of admission today, and that is that stock-based compensation is included as an expense on the income statement, but it is not included in cash flows. So there you go. That's worth the price of admission. So let's go to the next example, which is Apple. So Apple, they have, about $34 billion in net income, about $2.19 per share basic, $2.18 per share fully diluted. So you can see that they've got some dilutive shares, but not a ton. What is that, about 67 million shares or something along those lines. So not a ton from Apple's perspective. You can see also their income statement. They have share-based compensation of about $3 billion. And it's really interesting how similar Microsoft and Apple are. That's about 2.8 billion in 3 months for Microsoft, and about 2.9 billion for Apple. So they're actually pretty similar in that respect. So now we're going to move to a quiz. You're going to get a quiz because I'm going to show you the financial statements for a company, and I want you to guess who this company is. So, keep your thinking caps on for a second. The first thing we're going to look at is their income statement. Now, there's some clues on here, but the income statement, the net income per share, basic was $3.75 for the 3 months ended October 29th, and the diluted was $3.71. So that's about 4 cents. So if you have a guess as to who this company is, put that in the comments. I want to see if you guys can actually guess who this is. You'll get another shot at this. I'm going to show you their cash flow statement as well. But here's a clue. The clue is they made 27 cents per share in 2022, and it jumped to $3.75. So that's a pretty big clue. 9 months, they went from 118 to 707. But the point is that they had they had no dilution in the 3-month period. They had only 1 cent in the 9-month period last year, but that has now grown to 4 cents and 6 cents in the 3 and 9-month period. So I found that to be interesting. And then we have their cash flow statement here. And I think, yeah, good. I've got one more and no, I got two more. All right. So I have highlighted here their stock-based compensation. Hopefully you can see this better. They had about $2.5 billion in stock-based compensation. The 9 months ended October 29th of 23. And they had just shy of $2 billion in October 30th of 2022. So their stock-based compensation went up pretty significantly. That's about a 25% increase in stock-based compensation. But the earnings also went up tremendously. So, all right. So let's see. Who do we have guessing on this? We have Dresh, who is guessing NVIDIA. We have who else? Let's see. We have Nathan, who says it is Meta. And I think we have a question here. The stock-based compensation is not listed as an expense, correct? So you have to subtract it out manually for the net total. So Chris, I believe, I'm pretty confident that the share-based or stock-based compensation is included in the income statement. So you don't have to back it out. It is already in there. Where it gets backed out is in the cash flow statement, because it is a non-cash expense. So if it was not in the income statement, it would not need to be backed out of the cash flow statement. So, check me and correct me if I'm wrong on that, but I'm pretty sure that's correct. So we got NVIDIA, we got Meta, now we have Netflix. So we've got 3 guesses out there. Any other guesses before there is one of these 3 is correct? So you guys are on it. So let me just go ahead and share with you what it is. And Dresh, you are correct. It is NVIDIA. NVIDIA has grown their earnings significantly. That's obviously shown up in their stock price, and so they have quite a bit. Their stock-based compensation is up, but we would kind of expect that, because when bonuses kick in and companies make a lot of money, then their employees tend to make a lot of money as well. So there we go. So hopefully that was helpful. I'm going to go through some. Oh yeah, this was good too. I thought I would put this in there. Do certain segments issue shares frequently? So a lot of times when we're looking at companies to buy, a lot of times we'll look at their buybacks and we want them to be buying back shares. But are there segments, are there industries where the companies typically don't buy back shares? As a matter of fact, do they even issue more shares? And I would say that so Dresh is asking if he wins a free share. It would be, I would love to give you a free share, Dresh, but I don't own any. So I don't have any to give you, my friend. But that's a great question. So I guess the answer is no. But you made a great guess, man. That was, it's just the sheer satisfaction that you got the answer right. That should be enough, man. But do certain segments issue shares frequently? And the answer is yes. And those are utilities and REITs. So utilities will issue shares not as frequently as REITs do. As a matter of fact, in a few minutes we'll go over and remind me if I forget, but we'll take a look at Realty Income, which is like the monthly dividend company, and we'll just try to take a look at what their shares have done over the past few years. But REITs and utilities typically will issue shares. You won't see them buying back shares. So why is that? Utilities, their business model is that growth comes from investment. So their investment causes them to need more capital. So every year they're investing more and more into the grid, into their manufacturing process, and they need more capital to do that. That is how they grow their business. REITs, on the other hand, are required, and maybe BDCs as well. BDCs will be another one that I did not put on here, but they're required to issue about 90% of their, some modified AFFO. And so when they do that, they're giving all that cash back out to their shareholders. So they are in constant need for capital to continue to grow the business. So those two, in general, typically will add shares, not necessarily delete shares or buy back shares. So I'm going to run through these takeaways real quick, then we'll hit Realty Income, and then we will get to whatever is on your mind. So takeaways: most companies have dilutive transactions. So if you are scared off by diluted shares, then you're probably not going to find many companies to invest in, because most of them have dilutive transactions. I'm going to go ahead and reduce this back down so that there we go. That's much better. Information is readily available on the income statement and the cash flow statement. So if you want to know what's the impact of dilution on the shares, on the dollar per share in earnings, that's provided for you on the income statement. If you want to know what their stock-based compensation is, that's provided for you on the income statement. So you can see what the company is doing, and then even compare that to other companies if that's something that you're concerned about. So, a reason to assess management decision making. This is important because if you see a company going way out of bounds in their stock-based compensation, that may give you a clue that management is in it for themselves, that they are trying to pad their own pockets. And those are management teams that you really want to kind of stay away from. So, if you're really wanting to assess the management team, one of the things you can do is look at stock-based compensation compared to other companies. Then some segments like REITs, utilities, and now we've figured out BDCs, they issue shares to fund growth, and that's it. So let's get rid of this. We're going to stop that, and we're going to go to back over to, oops, that's not it. This one here. So we're going to hit the, let's go to Simply Safe Dividends, and we will let's pull up Realty Income, the monthly dividend company. Realty Income. You can see they got a dividend safety rating of 80, so that's pretty safe. Dividend yield of 5.84%. But what we're looking for is dilution. So if we come down here, and I did not do this beforehand, so this is going to be a surprise to all of us. So when I come down here to the shares outstanding, look at this. So in 2013, they had 192 million shares. Now they have 690 million shares. Now, obviously, part of that is this acquisition of Spirit. And so that's driven, shares up a lot. But you'll notice that shares are going up every year from 2013 all the way through to 2023 even. So shares are increasing every year at Realty Income. Why is that? Because they need the funds to grow. Now, conversely, I did look at this. This was WEC Energy, and we'll look at their share count. Their share count has grown, but in 2014, 15, and 16, but then it remained flat from 16 forward. As a matter of fact, it actually came down a million shares over that time period. However, they've been very open about in the next year to 2 years, they will probably issue I don't know how many, I forget, 50 million shares, let's say, of additional equity. So we're going to see that in WEC. But there are times when utilities can grow their business, they can grow their rate base without having to issue shares. So let's just for fun, let's see if they got that on the debt side, and you can see that that's where they're getting it. They were at 0.54% or 54% of total capital for net debt. There's not just a raw debt number in here, but debt to total capital was 54% in 2014. It is now 61%. So their debt load has increased over that time. So they are funding growth right now through debt and earnings, but mainly debt. And they're going to need to issue some equity at some point to kind of keep that ball rolling. So thought that would be helpful. All right, let's get rid of this. Remove. And I am back. So let's go back to what you guys have on your mind today. Hopefully that was helpful. Let me know if things like that are helpful, or if you'd rather see something different. I'm certainly open to that. Punisher66, he says hello from St. Louis. Thanks always for your content. I appreciate that feedback, my friend. And you know what I'm about, and what I love to do is help at least share what I know. I don't know everything, but I do have a lot of experience in this area. So I want to share that with people, because we are not competing with each other. We are competing together to try and win. And so my belief is, if we can work together and build our portfolios together and have iron sharpen iron, make sure we each understand what's going on in the market in a particular stock, I think we'll all do better in the long run. So that's my theory. And if it's not working, don't bust my bubble. So we got Peter here. So Peter is finally joining from Denmark. He is on holiday. And my friend, I appreciate you joining me on your holiday. That's amazing. So don't take this the wrong way, but it sounds like you really don't have a life. No, I'm just joking, my friend. It's I don't know if I would join me if I was on holiday. So that's great. I'm glad you're here, though. Let's see. We already did that. We have Billy Johnson, REITs. Yes, sir. Absolutely. That's good. I should have looked at this before, but you nailed it, my friend. And then yeah, good one, Dresh. That was Dresh asking if he had won a free share of NVIDIA. So yeah, utilities invest a ton to grow. They absolutely do. It is a constant battle for them every year to invest capital, because it is capital that gives them their return. So let's see. We've got Slammer 6789. Hey, a little late. Darn job getting in the way. We got to stop that, Slammer. I mean, you don't need that job, do you? Okay, maybe you do, because it's really the job that kind of gets us moving. It's a job that gives us the income we need. So there's really a couple of pieces here. One is the job. One is the way we manage our expenses, because if we can make more than we spend, we can invest the difference. And that's what we're all about. So it looks like I am caught up in the live stream. And that's unusual, because usually I talk way too much. So we have John J., who is in here as well. John, I just want to tell you that you are the one who inspired the lesson for today on dilution. So I appreciate you being here, my friend. So let me know, what do you guys want to talk about? Is there any news today? I think there is. I'm going to go ahead and show this screen, and we will kind of do this together. We're going to stop that, and we're going to going to share the screen again. Okay, so here we go. We're going to all go together to Seeking Alpha. And I like Seeking Alpha for several reasons, but one of them is that it has in my opinion, it has the quickest and a lot of times most dependable earnings release announcements. So Waste Management, I think, is releasing earnings today. So usually the first place I go to check is Seeking Alpha, but it's not here. So maybe I have that wrong. Because if I go to tip ranks and go down here to, oh, that's my calendar. If I go over here to tools and I go to earnings calendar, then today is Monday the 12th, and it should show me that Waste Management is reporting after the close. But apparently they have not reported yet. And the market has been closed now for what, an hour? So we're going to have a talk with those guys because that is just unacceptable. It would be great if we could actually see what their earnings were. I mean, they're up a little bit in after hours, but I don't see anything. I'll just refresh this just to see, but I don't see anything. They've got a preview out here, but I don't see their earnings at all. So we could go to their website, but it might be a waste of time. So let's go to my friend Eli. We will remove this from the screen. And Eli is wanting to know if I have any thoughts on T Rowe Price. Yeah, I do actually. So T Rowe's in my portfolio, and it is they report out earnings last week, and those earnings were kind of mixed. I guess they're still having outflows in their portfolio, but they are doing some things I think are really cool. As a matter of fact, if you go to their website and look at the slides, one of the things that's interesting to me is the growth in T. Rowe Price's ETF offerings. So as we all know, ETFs are probably the most interesting and I guess most sought after investments. So it's no longer mutual funds, it's now ETFs. Part of the challenge for T. Rowe is that they were kind of stuck in that mutual fund space, but now they are branching into ETFs. So I'm liking what I see there. I like a lot of things about their balance sheet, so I'm holding on to them. Let's take a look real quick in tip ranks here. And looks like it's being a little slow. Look at that spin. There we go. So let's go down here to T. Rowe, and we will find that T. Rowe ended the day up 3.44%. So that's not too shabby. $3.66. So I'll take that. So I guess to boil it all down, it might be too late for that. To boil it all down is T. Rowe is still struggling because people are still not going back into the market as they once were. So they're struggling with AUM, the assets under management, but they're cutting costs and they're doing a lot of things around ETFs from a strategic perspective that I like. So I'm just going to hold them and wait and see what happens. So those are my thoughts on that. So Tutomi says they do have earnings today, and yeah, that's right. So John Jay's asking, can a company dilute its shareholders without any negative effects? Would their shares being upset? Would their shareholders being upset? And will it not make shares less desired by investors? Yeah, that's obviously the challenge, right? Because anytime you dilute shareholders, then there's some uh, animosity that the shareholders will have. But if the shareholders are on board, like with stock-based compensation, and that's a reasonable approach, and they know that they need these skilled employees, and they're giving them these stock-based compensation, and it's reasonable, I don't think the shareholders have any issue with that at all. I don't, as a shareholder. So, but if they just start selling shares and dilute the company by 10% and just doing it because they want the cash, then I think they're probably going to struggle. Um, so those are my thoughts. I know that's a hypothetical question, but hypothetically, it could happen. But if they're reasonable in their approach, it's typically not an issue. So Peter says nobody is talking about the fastest growing trend in medical NVO and Lilly. So I think it's, I forget the name of it, Novartis or something like that. Potential in fat burning is longer than Viagra, uh, larger than Viagra. I'm not going to go with the puns on that. It's just my brain is just, full of those at the moment. But you're right, Peter. I mean, nobody really knows what Ozempic, and I forget what the NVO platform is. I'm losing it, but yeah, both of those stocks are set for that trend. And so the question is, how big is that trend going to be? They are priced in to a certain extent, right? Those Both of these stocks are well above, in my opinion, their fair value. The question is there more? And we'll just have to wait and see. But you may be exactly right, and I don't talk about it just because I don't own either of those stocks. But you could be right. There is potential there. So we will just have to wait and see. What would shareholders get having been diluted to make up for it? Um, well, so for instance, it depends on why they were diluted, right? So if it is a stock-based compensation, they could have gotten the skills and talent that were necessary to carry out the strategy of the company. That's very worthwhile for the shareholders, because without that, the company will just, falter. So, we definitely want them to have the talent that they need. If our companies are going to go below investment grade credit rating, and they need to issue equity to balance all of that out and get S&P and Moody's back on board with their capital structure, that could be good for the long term for the shareholder. And if they're issuing preferred shares, for instance, that's another thing for another issue with debt. But I guess at the end of the day, it matters uh, what they get for the dilution, and most of the time there's some value there. We just have to understand what that value is, and then we have to determine as shareholders whether we believe that that value is appropriate. And if we don't, then we move on to something else. And if we get it and we understand what management's doing, we buy into their strategy, then we stay with it. So that's the way I look at it anyway, John. That's a great question. Let's see here. Let us know about that and management effectiveness. Know about maybe you're talking about that being the dilution of what they get and management effectiveness. Yeah. So, I think it is one piece of management effectiveness. There's a lot, obviously, and it's very subjective. But I think management, if you look at this, like stock-based compensation, for instance, compared to other companies, and it's way out of bounds, then I would really question the intent of management, and that would cause a red flag for me. So, oh, Slammer 6789 with some info on insiders selling. So we've got some insiders selling. Let's go over to, I'm going to put this back on the screen. We're going to look at, you said that's waste management, huh? So let's play around with that for a second. The waste management, we've got ownership. Here's the insider trading. Yeah, you're right, man. Look at this. And these are all informative buys. Uh, I'm going to pull this up just to show you guys. But yeah, the insider confidence signal, you guys can see that, right? Is sold. I mean, they are, selling. They're selling out. So you'll notice here, and the reason I pulled this up, I'm going to take Slammer's comment off so you can see everything, is you'll notice that there's informative sells and uninformative buys and sells. And we'll show more transactions. So there's informative sales and uninformative buy, uninformative sell. What does that mean? Informative sells and buys are when a 10b5-1 investor, which would be like the CEO, CFO, some of the senior management, the board, when they buy just because they want to buy shares of the company, that's an informative buy. When they sell because they're ready to sell some shares, that's an informative sell. If they are getting issued shares from a compensation perspective, and so they're buying those shares maybe or being given those shares, that is an uninformative buy. And if they have what's called this is way too technical, but a 10b5-1 plan where they set aside, where they give instructions on selling shares way in advance. So well before there's any, it could be a year in advance. They would say, I want to sell shares a year from now for, X number of shares. So those shares would be sold, but that wouldn't be informative because it was done so far in the past, right? So it would be uninformative. So what we are interested in are the informative buys and sells. I don't really care about the uninformative. So, Slammer, you are exactly right. Take a look at this, guys. We have Charles uh, Bacher, who is the corporate development and chief legal officer, executive vice president. He sold 2,500 shares 6 days ago. He sold 2,500 shares 22 days ago. And then, we got some guy selling 185. What's he doing that for? We have the CEO selling 9,550 shares 27 days ago. And we have, again, this chief legal officer selling almost 2,500 shares again. So this guy they're selling quite a bit. So that's a good catch, my friend. So I'm not a waste management shareholder, and I just think that they are overvalued, and they have been. So but evidently management thinks that as well. So okay, Eli holding T Row as well. My cost is around 118, and I don't remember what my cost is in T Row. Let's take a look at it in here. So T Row is, cost is around 107. So that's not too bad, 107. And 118 is not bad either, my friends. So that works. Oh, you can't even see that. That's okay. I don't need to go back through that. But my cost basis is around 107. This is Greg. Greg, welcome to the program. I know I said hello earlier, but now that we're kind of far into this, sometimes my brain doesn't engage very well. So can I bug you and do a quick scroll to the charts on HESM and ET? So yes, let's do that. And I'm not sure what charts you mean. I don't do technical analysis, so I don't do charts like that. But I will show you what I have. We will add this to the stage, and we will go to. I actually hold HESM, and we'll look at Simply Safe Dividends first. So Hess Midstream, for those of you who don't know what this is, it is a midstream oil and gas company, and they are really the middle of the process. They get it from the ground to the facility that it needs to go to. So they are really about transportation, their storage and transportation. You'll see here there's a dividend safety score of 40 for HESM. Um, but let's take a look at some of their numbers here. And they really got started around 2016, and you see this growth in their dividends. And Greg, I'm going to pull you off of here so that we can see this a little bit better. So you see their growth here. You can see their growth in their dividend. Let's take a look at some of their financial numbers. Their DCF payout ratio is, somewhere in the 59% range, 60% range. So that is excellent. We Simply Safe wants it to be below 90%. It's below 65%. So that's good. The free cash flow payout ratio is excellent. Look at that, 20%, 19, 15. So those are excellent. What else do we care about? This is their free cash flow. You can see that's going down. They will obviously always have more free cash flow when the demand for gas is really high, but it's really volume based. It's not really based on the price of gas. Let's see, what else can we see that's interesting? You can see shares outstanding. This is interesting because Hess Midstream has shares that are on the public market. Stop me if this is like way too much, but Hess Midstream has shares that are on the public market, but they also have behind the scenes private shareholders. There's basically two of them. And so those shareholders own shares that are allocated earnings, but are not on the public market. So what you'll see from time to time is Hess Midstream, that those owners issuing shares of Hess Midstream into the marketplace. So there's one of two things that will happen there. HESM will either allow those just to go into the market, and then there's going to be a pricing for that, and so they'll be open to investors, or they will buy those shares, issue debt or something along those lines, and they'll buy those shares and retire them. So what you're seeing on this shares outstanding list are those public shares, those private shares, I'm sorry, being issued to the public. So you can see that in 21 there was about 7 million, then there was about 16 million, then there was about 15 million. So that happens, and there's quite a bit left out there. I don't remember exactly how many shares, but it does create a bit of a sawtooth growth structure from their price perspective. But again, it's important to understand that those private shares get part of the earnings per share. So them issuing shares to the public doesn't dilute ownership. So these shares that are issued here are not dilutive. They are simply public shares now that weren't out there before, because those private shares get part of the earnings per share, if that makes any sense. So the total earnings of the company are attributed between private and public at the same rate. So any private shares coming into the market aren't diluting shareholders because the earnings associated with those shares are coming onto the market as well. Hopefully that makes sense. Total sales, you can see that's growing. Return on equity, it looks good. Return on invested capital for a midstream oil and gas company, 23%. Come on. That is really good. So let's see, what else can we look at? Net debt to capital is pretty high, and that's because they've been buying these shares back, some of these shares, and retiring them. Interest coverage is not terrible. So hopefully, Greg, you said Simply Safe, so hopefully that's good. So now, I know a lot about Hess Midstream, don't know much about ET, but let's go there. Energy Transfer. So they have a 50 on the dividend safety score, dividend yield of about 8.94. Now let's take a look at, they were upgraded from 40 to 50, looks like, on February 17th. So that was pretty Oh, that was last year. No, that was 3 years ago. That's so they've been 50 for about 3 years. So let's go down and look at so Energy Transfer. Um, let's look at one other thing before I get too deep into this. There's a difference that I need to point out before we go further, and that is the taxation of Energy Transfer is a K1 because it is a limited partnership. HESM, so let's go back to that. HESM is structured differently. It does hold a limited partnership, but HESM itself is not a limited partnership. So you will see here that they are a qualified dividend and they issue a Form 1099. So if you are averse to K1s and the complication that comes along with that from a tax perspective, and you want something that is a little less complicated at tax time, I think HESM is a better play. That's one of the reasons that I have HESM, as a matter of fact. So let's go back to Energy Transfer. I wanted to make sure I pointed that out before I went further. But look at this. This dividend per share has moved around quite a bit, and that is because as a limited partnership, they have to issue a certain percentage of their cash flows. So let's take a look at some of the charts. DCF payout ratio, man, it was really high back in the mid-teens, but it is certainly very reasonable now. DCF per share looks good. Their free cash flow per share has improved. You can see here that they are issuing quite a bit of shares. I'm not familiar enough with Energy Transfer to know if it's similar to HESM here, but their share count is going up. Let's see. Return on invested capital is around 8%, 9%, and we saw HESM was around 23%. Net debt to capital is reasonable, and interest coverage is about 3.25, so that's pretty reasonable as well. So they're both pretty decent, but for my money, I like the consistency of the dividend. I like the qualified dividend that HESM offers. And so the question for HESM is their original parent company, who is Hess uh, Oil and Gas. The Hess HESS was their original owner, and they're one of the private shareholders. So the question is, now that Chevron is taking over Hess, what does that mean for HESM? And evidently, and they addressed this on the call, their earnings call, and evidently there is no provision for any future owner of those shares to do anything different, like pull them off the market or anything like that. They are a separate standalone company. So hopefully that's helpful. Let me know if there's any questions, Greg, anything that I may have missed there. Oh, okay. Yeah. The private and public. Yeah, absolutely. That is the first time I saw that was a couple of years ago. And so it caused me to go into their filings, and it took a while. I mean, it's pretty complicated. It's a complicated structure. So it took me a while, but I finally figured it out. And once I saw what was going on, I typically will buy when they issue these shares if there's enough, because a lot of people will panic and they'll go, "Oh, more shares, I'm being diluted. More shares are being issued." But at the end of the day, it doesn't really change anything other than put some more shares on the market, causing us to need more shareholders in HESM to get the price back up. It has nothing to do with company performance. So I don't blame you for getting tripped up on that, man. It is really complicated. So Primerica, this is Tutomi. Primerica is company I'm looking to add to my portfolio. Can you give input on it? Yes. And it's probably not significant input, but I can certainly look at some numbers here. PRI, America, PRI. So Primerica, life and health insurance. Um, 1.26% yield. They don't have a dividend safety score, which means that it's just not covered by Simply Safe Dividends. They've got some significant dividend growth, though. I mean, look at that. That's pretty impressive. Let's look at some of their data. Earnings payout ratio is fantastic. It's down in the mid to high teens. Free cash flow is ratio is the same way. Earnings are growing. Free cash flow is it's got a little bit of a dip here, but there's no telling what that is. Shares outstanding, they're buying back shares. They were at 56.6 million in 2013. They're now at 36.5 million. So they are buying back their shares, which is good to see from an insurance company. Return on equity, return on invested capital is around 16%, which is pretty decent. Net debt to capital looks very manageable in that 0.4%, or I'm sorry, 40% range. And interest coverage looks pretty decent, around 7.63. So yeah, Primerica looks pretty good. There's actually quite a few of these insurers that are looking pretty good right now. So I currently own Prudential, and there was one that was in the Discord. And if you're not in the Discord, I would really encourage you to do that. There's a lot of good conversation that goes on there. If you need a link to the Discord, just look in the comments to this video and select it and go in. And if you don't have a Discord user ID, sign up for that and then join the Wealth Circuit Investing Discord channel. And there's a lot of good conversation that goes on there. So anyway, just to follow up to Tommy, those are my thoughts on Primerica. We'll just have to see. So we have Peter, is ICE an alternative to CME? Yes, it is. I did an analysis that I actually shared in my collaboration tier for all of these investment services companies. ICE was one and CME is another. And actually, I think ICE is a better alternative at the moment than CME. So that's kind of where my analysis came in. Both of them are fine. They're good investments, and it's a subjective thing. It's not like there's these specific numbers that add up to anything. But when I looked at all of the factors in the analysis, I just decided that ICE was just a little bit better than CME. I did not add ICE to my portfolio, but if I were to add one or the other, it would probably be ICE at this point. So, Peter, that's a great question. Yeah, thanks, Slammer. Only 6 thumbs up, but we have 12 watching. We actually have 14 now, so we've got a couple that have jumped on, and I appreciate you guys doing that. And it looks like we have surpassed the hour. So it is an hour and 3 minutes into the broadcast. So I appreciate you guys so much. You don't know how much excitement it is for me to get ready for these live streams, to hear what's on your mind. And I just really enjoy the camaraderie. I enjoy the way we can discuss stocks. Again, if you want more of that and you don't want to wait for the live stream, come on into the Discord channel. I'd love to have you there. Follow the link in the comments below. Don't forget that Alpha Picks thing because it does expire. I think it expires. The special deal expires on the 15th, and rumor has it that that it's going to actually go up in price. So it's something that is interesting to me, interesting enough to try it out. It may not be interesting to you, but for them being over 100% return versus a 32% in the S&P 500 gives me, reason to kind of, raise my eyebrows and want to take a look at it. So anyway, just wanted to pass that on to you, give you that opportunity if you're interested. And I can't think of anything else. So I will see you guys on the next video.